Welcome to Lesson 8, Accounting for Sales Tax. Hello and welcome back, everyone. I'm so glad to have you here for Lesson 8 in our FA1 series. Today, we're going to learn about accounting for sales tax, a very important topic for any business, big or small. By the end of this lesson, you'll clearly understand what sales tax is and why it's used, how to record sales tax when making sales to customers, how to handle sales tax when the business buys from suppliers, and why sometimes sales tax is included in the cost of goods and other times it's not. Let's break this down step by step in the most simple and detailed way possible. What is sales tax? Sales tax is a type of tax that businesses add to the price of goods or services when they sell them to customers. The business collects this tax on behalf of the government and later pays it to the tax authority. This means the business does not get to keep the sales tax. It is just collecting it temporarily. Because the business doesn't keep this tax as profit, it should not include it in its sales revenue. So, when a business sells a product, the actual sale amount is recorded without the tax. Accounting for sales tax on sales, also called output tax. Let's take an example. Imagine a business sells goods for $600 and adds a 20% sales tax, which is $120. So the total price the customer pays is $720. Now, how does the business record this transaction? First, the full amount received from the customer, which is $720, is recorded as money coming in. But the business cannot treat all of this as income. Only $600, the value of the goods sold, is counted as sales revenue. The remaining $120 is recorded as sales tax collected, which is money the business will pay to the government. So, to sum it up, the business records $720 as money received. Out of this, $600 goes into the sales account. The remaining $120 is recorded in a separate sales tax account because it is owed to the tax authority. Accounting for sales tax on purchases, also called input tax. Now let's look at the other side. What happens when the business is the one buying goods or services and it pays sales tax? This depends on whether the business is allowed to reclaim the tax or not. This is a very important detail in accounting. Case 1. When the tax is recoverable. If the business can reclaim the tax from the government later, the tax is not treated as part of the cost of the goods. For example, imagine the business buys goods worth $400 and pays $80 in tax. The total is $480. Since the tax is recoverable, the business only records $400 as the purchase cost. The $80 of tax is recorded in a separate account called the input tax account because the business expects to get this money back. So the purchase cost is just $400, not $480. Case 2. When the tax is not recoverable. Now, if the tax is not recoverable, the business must bear the full cost, including the tax. Let's use the same numbers. The business buys goods for $400 and pays $80 tax, so the total paid is $480. But this time, the tax cannot be claimed back. In this case, the full amount of $480 is treated as the cost of the goods. So both the purchase cost and the sales tax are recorded together as one total amount because the business is fully responsible for paying it. Why does this matter? Understanding how to treat sales tax is very important because businesses must report the correct amount of tax to the government. They must not overstate their income by including tax in their sales. They need to know whether or not they can recover the tax they pay on purchases. And finally, it helps keep the accounts clean, organized, and accurate. Summary of what you've learned. Let's quickly review. Sales tax is collected by businesses but belongs to the government. Sales records should not include tax in the revenue. When a business sells, the sales amount is recorded without tax, and the tax is recorded separately as a liability. When a business buys, if the tax is recoverable, it is separated out and not counted in the cost of purchases. If the tax is not recoverable, it is added to the purchase cost because the business must pay it. I know it can feel tricky at first, but with practice, it becomes second nature. If this lesson helped you, please give it a thumbs up, subscribe to the channel, and share it with your classmates or friends who might also find it helpful. And if you'd like to support this channel even more, feel free to leave a comment or share this video. Every little bit helps keep these lessons going. When should businesses record sales tax? This might seem like a small detail, but it is crucial in accounting because businesses need to know exactly when to enter sales tax into their financial records. If they record it too late or too early, it can cause big problems, like incorrect tax payments or financial mistakes. So, let's break it down step by step in the easiest way possible. Understanding when sales tax is recorded. Sales tax must be recorded as soon as it first arises. But what does that mean? Well, it depends on how the transaction happens, whether it is a credit transaction or a cash transaction. Let's go through each one with clear explanations so you can fully understand. Case 1. Sales tax on a credit sale or credit purchase. A credit transaction means that the money is not paid right away. The customer will pay later, or the business will pay later if it's making a purchase. When do we record the sales tax? The sales tax must be recorded when the invoice is received or issued, not when the payment is made. Let's say you sell a product for $1,000 on credit, and there is a 10% sales tax, which is $100. The customer has not paid yet, but as soon as you issue the invoice, you must record the sales tax of $100 in your accounting system. The same applies if you are buying something on credit. If you receive an invoice from a supplier for $2,000 and the tax is $200, you must record that tax as soon as you get the invoice, even though you will pay the supplier later. Key point: for credit transactions, sales tax is recorded when the invoice is received or issued, even if the money has not been paid yet. Case 2. Sales tax on a cash sale or cash purchase. A cash transaction means that the money is paid immediately when the transaction happens. When do we record the sales tax? For cash sales and cash purchases, sales tax is recorded at the exact moment when the money is received or paid. Let's say a customer comes to your store and buys an item for $500 plus a 5% tax, which is $25. Since they are paying in cash, you must record the sales tax of $25 immediately. You do not wait until later. You record it at the same time you receive the money. The same applies if you are buying something in cash. If you pay a supplier $800 for materials plus a 10% tax of $80, you must record the tax as soon as you make the payment. Key point: for cash transactions, sales tax is recorded immediately when the payment is made or received. Why is this important? Recording sales tax at the correct time is important because it ensures accurate financial records. It helps businesses stay compliant with tax laws. It prevents errors in tax reporting, which could lead to penalties or legal issues. It helps businesses track their tax liabilities correctly so they know how much they owe to the government. If a business delays recording sales tax, it could underestimate how much tax it owes, leading to a tax penalty. If it records tax too early, it could create cash flow issues. That's why timing is everything. This is a crucial accounting principle, and it is often tested in exams. Make sure you practice it well. If this explanation helped you, make sure to like this video to support the channel. Subscribe and turn on notifications so you never miss an upcoming lesson. Share this with friends or classmates who are learning accounting. Thank you for learning with me. See you in the next lesson.